Retirees and those planning for retirement are facing a new era of rising interest rates. This presentation is intended to educate retirees and those planning to retire about the risk posed by rising interest rates. It addresses a fundamental shift in retirement income planning, a risk that the last generation of retirees did not face. Our story begins with the global financial crisis of 2008, a historic event that nearly toppled the world financial system. As those dark days move off the front page into the pages of history, individuals who need reliable retirement income are facing a major new challenge. The U.S. economy is growing, and that's good news, but it's come at an enormous price. The white bars in this chart show you the growth in the economy since 1997 and a forecast for 2013 and 2014. You can see how the economy has sprung back from the depths of 2008 and 2009. Growth has returned. But it has come at a price retirees are being forced to pay, a change that may alter retirement investing profoundly in the years ahead. For 30 years, interest rates have declined. The yellow line charts the trend of interest rates from 1982 to the end of 2012. The green bars show the return on intermediate-term bonds in each of the 31 years during this long cycle of declining interest rates. The red bars show that during this 31-year period, intermediate-term bonds lost money in just 2 calendar years. That's quite a run. Retirees were able to rely on stable income by investing in bonds during this period, and they benefited enormously from falling rates. But in the years following the financial crisis, interest rates have been hovering near zero. The Federal Reserve, the nation's central bank, has kept rates low to stimulate growth. But recent strengthening in the economy could cause the Fed to raise rates to prevent the economy from growing too fast and sparking inflation. The possibility that interest rates will rise for a long period is one that retirees have not faced in over a generation. That has fundamentally altered retirement income investing. When interest rates rise, the price of a bond falls, and if that trend continues year after year, it could decimate a retiree's savings. That's the situation retirees are facing today. While the last generation of retirees had interest rate trends in their favor, the next generation of retirees might be facing a rate trend working against them for a long time to come. Regulators are concerned. FINRA, the self-regulatory organization for Wall Street, in early 2013, issued an alert to investors. The regulator suggested investors consider shortening the duration of their bonds and bond funds. Shorter-term bonds are less volatile than long-term bonds and can pose significantly less rate risk. But they also provide lower yield. By shortening duration, you'll need to settle for less income. How could rising interest rates affect you? If you need stable income, what should you do? Do you need to radically shift your portfolio? Can you afford to shorten the duration of your bonds or bond funds and settle for less income? If you do shorten bond durations, how could you make up for the income you give up? These are new questions for retirees and those preparing for retirement. Do you remember the phrase, "Past performance does not guarantee your future results"? Of course you do. Just about all TV, internet, and print advertisements for investments issue that warning. But just because you can't expect history to repeat itself does not mean you should ignore it. What history shows is that rising interest rates are not necessarily so terrible for investors. In the last rising rate cycle, from 1948 to 1981, bonds declined in value in just 5 calendar years. The total return on bonds was positive in 26 of those 31 calendar years. During that 31-year cycle of rising rates and declining bond prices, intermediate-term bonds averaged a 3.8% annual return. The risk of bonds, as measured by standard deviation, their volatility, was 4.3%. That's a low volatility level relative to stocks, but it's also a low return. Consider this. During the 31-year period of rising rates, if you had added stocks to the mix, say by placing 60% of your assets in stocks and 40% in bonds, you would have realized twice the average annual return of an all-bond portfolio. Although stocks were more than twice as volatile as bonds, they rewarded investors with more than twice the return of bonds annually. Consistent with modern portfolio theory, stocks performed very different from bonds during the long climb in interest rates, illustrating the importance that diversifying played in the last long cycle of rising interest rates. And finally, here in this portfolio, you see the improved risk-return trade-off that resulted from adding 90-day Treasury bills, one of the world's least risky short-term securities for income, to a plain vanilla stock and bond portfolio. Broadly diversifying across short-term Treasury bills, as well as a broad spectrum of stocks and bonds, would have boosted the average annual return on a portfolio to 9.5%, while increasing portfolio volatility only slightly. What's most interesting is that when you examine how bonds might have affected retirement income portfolios over the entire 60-plus year post-World War II period, spanning both rising and declining interest rate cycles, bonds have actually been a very unpredictable investment. Although bonds are often regarded as the most conservative investment instrument, they showed a huge difference in returns, depending on whether rates were in a rising or falling cycle. During the rising rate cycle, the average annual return on bonds was less than half what they averaged during the declining rate cycle. Meanwhile, stocks and cash in 90-day Treasury bills averaged about the same annual return in both the rising and declining rate cycles. To be clear, the 11% annual return on stocks and the 4.5% return on Treasury bills stayed roughly the same through both the rising and falling interest rate cycles. However, the average annual return of 3.8% on bonds from 1948 to 1981 was less than half the 8.8% that bonds annually averaged during the 1982 to 2012 period. The performance of stocks, bonds, and cash over this period demonstrates why diversification and a strategic approach are so important to long-term investing. Hopefully, you now have a better understanding of the new era of interest rate risk that retirees are facing. But we would be remiss if we did not leave you with some practical ideas to consider to address the issue. Start by re-evaluating your portfolio's holdings that are sensitive to changes in interest rates. Don't overreact. Remember that the last cycle of rising rates was not so terrible for investors. Avoid trying to call the market or making big bets on the next hot asset class, industry, or stock. Create a portfolio and support system that will encourage you to stick with a strategic asset allocation policy. Consider shortening durations on fixed income holdings to limit your portfolio's interest rate risk. Explore how bond duration can help you manage a sudden surge in interest rates. If you decide to lower the duration of fixed income investments, remember that will mean settling for lower expected returns, and give careful consideration to how you might replace the annual income you can expect to give up by taking less risk. Write a policy for allocating your assets across a range of investments that have historically performed different from one another. Align your portfolio with your risk tolerance to help you avoid reacting emotionally when markets become volatile. If you have any questions about this presentation or how to manage your portfolio, please contact us. If you would like to receive more special reports like this one, please connect with us on social media or sign up to receive our newsletter.